Good morning. Welcome to CATEX TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Tuesday, January 6, 2009. It's 11:30 a.m. Eastern Standard Time in the U.S. It's 4:30 p.m. in London. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX TV. We have a breaking story before we get to the Rod Fox interview. About 6 hours ago, 100 Boston firefighters finished up on a fast-moving fire in Boston near Fenway Park. It was a 4-alarm blaze. It caused at least $5 million in damage. It knocked out 6 restaurants and a slew of street stores on Peterborough Street near Fenway Park. As I mentioned, the 84 to 98 Peterborough Street block was completely destroyed. Apparently about 150 people were evacuated last night. The firefighters got the blaze under control at about 4 a.m. Eastern Standard Time. Now to our news. Yesterday we heard from Guy Carpenter and from Willis, two of the big three brokers, talking about their view of the reinsurance market. Today we hear from the biggest broker, Aon Benfield. They released a study this morning saying that the global firming of reinsurance prices that were seen on 1/1/09 is expected to continue through the July 09 renewals. Aon Benfield took capital as the nearest proxy for capacity. Aon Benfield estimates that reinsurer capital is down 8 to 10% through the end of September 08. It's going to be down a total of 20% for the year ending December 31st, 08. They say, of course, that 90% of the decrease in reinsurer capital is due to the credit and liquidity crisis, with the balance, the other 10%, flowing from catastrophe losses. This firming of the reinsurance market is one of the first caused by asset-related issues rather than significant ceded losses. That's one of the questions that we raised with Rod Fox in the interview that we recorded about 1 hour ago. We're going to go to that interview now. About the upward movement of reinsurance pricing, we have with us on the phone today Rod Fox, who is the CEO of Tiger Risk Partners. Rod, are you there?
I am there, Frank.
Rod, very good. Thank you for taking the time today. Happy New Year. I hope you and your family had a nice holiday.
We had a wonderful time. Same to you.
Thank you. Listen, one of the things that really has struck my attention over the past few days is this argument that has come out in full view now, that one of the other impact points on reinsurance pricing is not just the frequency of catastrophes, but in fact it's the diminishment of the corpus of the various portfolios and net values of the reinsurers themselves, combined with the diminishment of their investment income, that it's contributed to the shrinkage of capacity that they can actually write, and now we have a scarcity of product. Is that true as well, do you think?
I think it's absolutely true, and it's interesting. I mean, obviously everybody's aware of the global financial crisis, and to a degree, I think the reinsurance industry, for the most part, thought we were sort of immune to this. Not totally, but generally immune to it. And I think it was actually probably back in September, October. I was probably, of a similar mindset. And I was sitting at this large industry meeting, and I was just listening. And I walked away from that meeting, and I said, holy Christmas. We're going to have a major gap between supply and demand because people's capital is shrinking. Not necessarily through any fault of their own, just global market downturn. I mean, the S&P Insurance Stock Index for 2008 is down 60%.
Wow.
Right? So book values were shrinking, which was causing an issue. Meanwhile, demand for reinsurance was going up. So I came back from this meeting and I started talking to people, and really nobody was buying it. And I've just seen this crescendo starting to grow to where I think we've got a very serious hardening, at least in some areas of the market, that's coming in 2009. You saw it at January 1, but I think it starts to get worse. And just my rough numbers, reinsurer capital has dropped by roughly 20%. I think demand has increased by at least 5 and probably up to 10%, because people, the clients with smaller capital bases are buying more. They're being forced to protect themselves more. They can't lever at all in the capital markets. So you've got a potential 25 to 30% supply-demand imbalance.
Wow, that's considerable.
Yeah, that's going to cause issues, I think, and it already has.
And then I guess as well in this market, I saw this morning that Hardy Underwriting is planning on increasing capacity by getting new money in. But I suppose that they're the exception. It might be difficult to attract new money. Do you think we're going to see another renaissance of a Bermuda redo, so to speak, in the future?
No, a new renaissance, no pun intended.
Yes, sorry.
I think in the fourth quarter of 2008, new money was very hard to come by. I think it's still hard to come by. I think people are waking up and seeing this supply-demand imbalance. I mean, it's no secret. A lot of people place all their attention on the catastrophe market as the bellwether of insurance pricing. Every insurance and reinsurance market is not hardening. I mean, the international market did not see significant hardening at year-end. The retro market is up significantly, but med-mal in most areas is not. Property per risk and quota share to date has not. But people are waking up in general to the imbalance, and I think you're not going to see a flood of new capacity, but I think you'll see some. But I think you hit on the difference. The difference between this market change and prior years was with this little sort of hint of market hardening. Prior years, you'd see $5, $7, $10 billion of new capital lining up, either in terms of new formations, sidecars, cat bonds, etc. Most of those vehicles are not really available today. They're not available in any size. And when you're talking about a 30% supply-demand imbalance, that's billions of dollars required.
That is billions that is billions of dollars required, and in fact, I guess the typical door that the industry would knock on now would be the capital markets, and with the insurance-linked securities market, which I suppose this might be a bit of a generalization, is somewhat dominated by hedge funds, who in turn have been impacted by capital calls of their own. Where do you see that ILS market right now?
I think, you talk to the people in the market and they say everything's great, it's vibrant. I think it was shut down. I think the sidecars were shut down. I heard an example recently of a reinsurer trying to put a sidecar together, and they approached in excess of 150 hedge funds, and not one person participated. Again, this is not the rule. It will not be, every situation, but I think the market has been decreased significantly. I don't think it's going to be down forever. I think it'll probably come back even more vibrantly as we come out of this crisis. But the global financial credit crisis has not eased yet, and the hedge funds are having redemptions, and effectively they're taking anything with liquidity and bringing it back in house. So the free flow of capital, and particularly the post-event capital, is hard to come by, which makes reinsurance an attractive risk management tool. And then on top of all this, Frank, so you've got really limited new capital flowing in, and who wants to issue new equity? So debt isn't available. Who wants to issue new equity at historic low prices?
Right.
Really no post-event capital. You've got very low investment yields. I'm sure you've seen the table. If you want to write to a 92 combined ratio, and you can look at different investment yields, but we're again at historic low investment yields. You've got loss emergence. Ike doubled versus expectations versus modeled results, and then you've got